Good morning, and welcome to the second edition of The Global Perspective, where on the first Thursday of every month, we bring in the experts to discuss and provide actionable insights into the key issues driving markets today. For today's topic, we'll be speaking about China and changes in regulations and policy, and importantly, how this impacts investors. And of course, who better than Ian Beattie from NS Partners to share his insights and analysis with us today. Ian is co-CIO, a partner and portfolio manager at NS Partners. Ian and his team have been managing global emerging markets mandates for over 25 years now, and they've built up a formidable track record in that time. Ian also manages the Ned Group Investments Global Emerging Markets Equity Fund. Ian, good morning, and how are you?
Morning, Anil. I'm great. All the better to be back chatting to you again.
Definitely. That's wonderful. So glad to have you here. So Ian, I've got some really serious questions for you, but I'm sure you'll do very well. And most importantly, we just want to hear your views and analysis on these, please. So the first one is that China has just been such a dog, over this year to date, whereas in complete contrast to the US, where it's been a complete outperformer. Poor economic growth is one thing, and just having a weak economy is one thing. But there is a perception that Xi is actually changing the rules in China now, and that's leading to a lot of disruption, and investors just don't know, what to do next. So, what does common prosperity really mean for investors, and can China even be considered investable at this point?
Thanks, Anil. I think you're asking exactly the right question. This is the crucial question I think all investors need to ask at the moment. And I believe we're certainly at a turning point for policy, or certainly the backdrop, the mood music for policy that will influence all policy going forward. There has been an increase in the regulatory risk premium, which we talk about and which we measure. But I would point out, though, that some of the issues have been addressed in other countries, or might well be, just in a different way. And I'm afraid that's emerging markets for you. That is why the risk premium is higher. As investors, we do not have that institutional quality and that sort of safety net of seeing these changes come in a measured and controlled manner. But some industries were either boasting about avoiding the rules, or were running up significant externalities or social costs. Others were abusing monopoly positions, and some were doing a combination of all three. So I'm not defending the way that some of the regulators and policy makers have acted, but many of these actions may well have needed to have been taken, and they are very defendable in most cases. In fact, we could say some of these policies sound a bit like Build Back Better that we hear a lot about in the UK, or other political slogans that get bandied around in the US or France over recent years. And common prosperity could be described as a reaction against extreme or rapidly increasing inequality. Now, it is argued by some as a way of ensuring China actually remains competitive in, say, the internet space, so that the new internet giants don't end up stifling the next generation of disruptors, ensuring innovation and technological developments and growth can continue. And I think there is some merit here. This is definitely part of the equation. Now, the other thing that gets thrown at Xi is that he's anti-private sector. I think it's very clear that he is pro-state-owned enterprise and pro the state and the party, and not necessarily very pro-private sector. But that isn't the same thing as saying that he's anti-private sector, and it's not the same thing as saying he's anti-market or anti-capitalism. Otherwise, why would China have very recently just introduced market-based pricing reform in the power utilities sector, just when there is a crisis in power? That is radical, and it's happening at exactly the same time. So I think it's much more nuanced than that. China isn't turning its back on the market. I think it knows it needs private sector innovation and job creation, wealth creation, and the efficiency that the private sector can bring. But That doesn't mean that we then jump and assume that they want Anglo-Saxon or US-style red in tooth and claw capitalism. It doesn't mean that the free market becomes a religion. In fact, the model might look more like continental European take on capitalism, or even their near neighbours in Northeast Asia. So I agree, this is definitely a key turning point. You might argue this is a sea change moment. The fact that Xi is launching a historical resolution soon, and there have only been two of these before, one in the 1940s and one in 1981. So if they're that rare, I think we can assume that this is a big moment for Xi Jinping. So therefore, the environment has definitely changed. But I don't think it's quite as extreme, either bullish or bearish, as some people are making out. But it's definitely a change in environment, and our investment approach has to take account of that.
Thanks, Ian. And what about, just from a regulatory perspective, these VIE structures? I mean, is it a no-go area? Should investors be jumping in and not really caring about the risks? So what really are the implications for investors, please?
Yeah, another really good question, because VIEs have always been an issue. So they are an issue, and they always have been. They are a flaw in the investment hypothesis at the very least, because you don't have such a good claim on the assets. But not all VIEs are the same, actually. So some are flakier than others, but they definitely should be taken into account of, and if you can avoid them, all the better. Now, they usually occur in offshore listed companies and those in sensitive areas where foreigners aren't really allowed to own the assets. Now, I think we can and should invest more in local companies that are listed locally and whose businesses are in line with government policy and not running against it. I think that makes sense in any jurisdiction, but this has been a reminder that it's more important where you have less claim on those assets. So yes, they're definitely an issue. I think there's always somewhere where it may be worth the investing for the potential upside, but this is a reminder that the risk premium is there for a reason, and we should be very cautious about it.
Thanks, Ian. And just on China, I mean, it just seems like it's not as good or not as bad as most people make out to be. So, what are you really seeing that's exciting in emerging markets right now?
Yeah, well, definitely emerging Europe probably looks a little bit better as the prospects for the rest of Europe look better. But I think the area where we're most excited about at the moment is that we're seeing really strong money numbers coming out of Southeast Asia, ASEAN, and even Taiwan and Korea doesn't look too bad either. But definitely Southeast Asia, those money numbers are really strong. And that's going in a different direction to the rest of the world. So just as the developed world sees their money numbers decelerate, which puts us in probably the more bearish camp for economic prospects everywhere else, we're seeing these Southeast Asian countries really accelerate. Some of them are opening up plays, some of them have been exporting their way out of trouble, but all of them look like they do not have some of the policy setting or inflation issues that the rest of the world will have very soon if they don't have now, and yet they've got this improving backdrop. So in the short term and the medium term, these look very, very attractive opportunities to us.
That's brilliant. Ian, thanks very much. I mean, just as a very quick summary, I was just taking some notes as you were speaking. So, you said that, China and common prosperity, it's, really a crucial question. You mentioned that there is a rising regulatory risk premium, but, ultimately for the long term, China is, they actually are trying to put the right policies in place. They just have their own unique way of doing things, which might shock some Western investors. But they're definitely very pro-corporates and pro-private sector because they do actually need the innovation and the efficiency that the private sector brings. So they definitely don't want to kind of stamp that out. They actually want to work with the private sector. The other thing you mentioned on the VIEs is that it has always been an issue, and maybe perhaps people are just more aware of the risks now than they were in the past. You mentioned that VIEs are not all the same, so people can't just kind of assume that they are all the same and treat them all the same. But preferably, if you can find high quality and growing local listed businesses to invest in, that would be preferred, and especially locally listed businesses that are operating in line with government policy. I think that's, it seems like the best option if you can find those. That would be wonderful. And then just to close up, I think you just mentioned about the money numbers in emerging Europe, which you find to be quite interesting, and you're seeing really strong at the moment numbers coming out of Southeast Asia as well. So Ian, just before we close up, any last words from you?
Not really. I hate talking about generalities, but I know that's kind of what we're doing in these sort of settings. But in the last few years, people have been investing in consumer discretionary in China and staples in India. And I think in China now, the next stage is real companies doing what China does best at. Where the global leaders will come from, China will still produce many of those. There is a question mark about whether they will have the real high-end innovation in the internet and those sort of high-tech areas. We'll have to watch to see if they can get back and become a global leader in those areas again, like they have been. Okay, so the last 10 years, it's all been basically West Coast US and East Coast China for leading those developments. And maybe we have to see, the jury's out, whether China can get back its leadership position in there as the innovation continues. But there's still plenty of other areas where China leads and will continue to take global market share. And that will still be very interesting for investors to look at.
Brilliant, Ian. That was wonderful. Thank you very much for your time this morning. To all our investors dialing in, we really appreciate your time as well. There is a QR code that will be coming up on your screen shortly. Please do use that to provide some feedback to us. We always value your feedback, and we would like to improve these sessions and make it more useful for you as well going forward. So just coming up in December, we have First Pacific Advisors, so please look out for that. You'll see the invite coming out in the next few weeks. We definitely look forward to having you here. Otherwise, until then, keep well and stay safe. We will chat soon. Take care. Goodbye.